Hi, in this video we'll be looking at cost volume profit analysis and doing a basic break-even. Now the starting point with cost volume profit analysis is with this expression here, profit is revenues minus costs. And what we're going to do with this is just to expand out the right hand side. So we can take profit is revenues and split out costs into variable costs and fixed costs. We then can expand it a little bit further by breaking down revenues into, and we're going to assume here that we've just got one type of product. So the amount of revenue that you'll get will be based on the price of each product and how many of each product that you sell. The variable costs will be based on the variable cost per unit and the quantity that you sell. And fixed costs will be fixed costs. So what we have here in the last equation actually is pretty much everything that we need to do all of the cost volume profit analysis that we want. Break-even analysis, target profit analysis, we can do a whole range of things with this. And the really neat thing is if you have four pieces of information, you can work out profit. So these four inputs that you require, you need to know the price of the product, you need to know the quantity that you're going to sell, or you expect to sell, the variable cost per unit, and the fixed cost per unit. So to the extent that the variable cost and fixed cost structures are sort of within your control, pricing is to an extent within your control, although obviously affected by market conditions, and then quantity will also be affected by market conditions. But if you have those four pieces of information, hopefully good estimates, you can then work out what your profit is going to be. Or if you have a target profit figure and you need to work out quantity, you have profit and you have the other elements, so price, variable cost, fixed cost, you can work out quantity. So as long as you have 4 of the 5, you can work out the 5th. So we're going to do a fairly basic example of this using some of the information from the Accounting MBA second edition, or the Accounting 2 Managerial, Chapter 10 in the MBA book, Problem 17, Chapter 9, Problem 17 in the Managerial. But the key information that we have in this is some variable cost information, where we've got labor, overhead, and variable sales and admin totaling $70 per unit. Fixed costs, overhead, and sales and admin totaling $650,000, and an expected sales price of $200 per unit. So we're going to take this information and load it into the equation that we just created before. So if we look on the very bottom line there, this is a break-even analysis. So for break-even, you're looking for a 0 profit. So we replace profit on the left-hand side with a 0, and what we're going to do is sequentially load in the other information. Price is 200, so that gets put in. Variable cost per unit is 70, so we put that in. Fixed costs are 650,000, and we put that in. Now at that point, we can simplify that down somewhat, but the only variable which is still unknown is quantity. So all that we need to do at this point is, simplify it down and get quantity on one side and all the numbers on the other, and we'll be able to solve for quantity, which is what we're about to do. So we combine the price per unit and the variable cost per unit, because they're both multiplied by quantity, gives us 200 minus 70. And that is actually your contribution margin per unit. The 200 minus 70, price minus variable cost. So you might not even be told price or variable cost. You might just be told contribution margin, but that's enough to go on. 130 times quantity minus 650,000. Move the 650,000 to the other side. Add 650,000 to each side, I should say. Swap the sides over, so we end up with quantity on the left. Divide both sides by 130, so you get quantity just down to 1 unit. And actually work out the right-hand side, and you end up with 5,000 units. And that's all that we need. For a target profit of 0, a break even, you would need to sell 5,000 units at a price of $200 a unit with $70 variable cost per unit and $650,000 fixed costs.